Hi, welcome to AAM's 2023 Outlook webinar. I'm Reed Nuttall, the Chief Investment Officer at AAM. Today you'll hear our views on the economy and attractive opportunities in the markets. We'll be hearing from our experienced team of sector leaders and senior portfolio managers, but to save time, I'll ask them each to introduce themselves. A couple of housekeeping items. If you have questions, please ask. They'll be routed to us and we'll come back to you. If you'd like a copy of today's slides, please contact your portfolio manager and they'll be sure to get you a copy. Take it away, Marco.
Good morning. My name is Marco Bravo and I'm a senior portfolio manager at AAM. The macroeconomic outlook for the US economy continues to be heavily influenced by the outlook for inflation. The headline CPI, or the Consumer Price Index, recently hit a 40-year high of 9.1%, but has steadily fallen and most recently is up 6.5% on a year-over-year basis. The fall in CPI has largely been driven by falling energy prices, and in addition, consumer preferences have moved away from goods to services, and as supply chain disruptions have eased, we've also seen prices on goods fall over the last 3 months. In fact, the headline CPI over the last 3 months on an annualized basis has fallen to below the Fed's 2% target. At the core level, which excludes food and energy, things are a little different. Prices for services have continued to rise largely due to shelter-related prices. We expect core CPI to remain above the Fed's 2% target this year as a tight labor market and rising wage pressures present upside risks to inflation. With inflation coming down, the market believes the Fed is close to ending its rate hiking policy this year. Fed funds futures is currently implying 25 basis points of rate hikes at each of the next 2 FOMC meetings. What's interesting is the market continues to push back against the Fed's own projections and is expecting the Fed to pivot and actually begin cutting rates in the second half of this year. This has led to easing of financial conditions with lower treasury yields and higher equity prices, and actually could make it harder for the Fed to get inflation lower without significantly hurting the economy. Here at AAM, we think the Fed will raise rates a total of 50 basis points, bringing the Fed funds rate to 4.75 to 5%, and then pause and leave rates unchanged through the end of the year. While economic activity is expected to slow this year, labor market conditions still remain relatively healthy. If you look at job openings relative to total unemployed, that remains close to 2 times. And this tight labor market environment should keep wage growth high and support consumption in the near term. But as we get later into 2023, we're expecting labor market conditions to weaken and the unemployment rate to begin to rise. Recent economic and activity data is showing signs of a slowing economy as the effects of the Fed's rate hikes reduce spending and investment. After rising 1% last year, the consensus is forecasting real GDP in the US to increase by only 0.1% in 2023. Our outlook for economic growth is in line with the consensus, as we think GDP will come in somewhere between negative 0.5% to positive 0.5%, but we view the risks as skewed to the downside. So to summarize, we expect inflation to trend lower this year, but remain above the Fed's 2% target. We're expecting a total of 50 basis points of additional rate hikes from the Fed, with the Fed then pausing and leaving rates unchanged this year. We don't think the Fed cuts rates before 2024. We think the odds of the US entering a mild recession this year are high and the risks are skewed to the downside. So against this backdrop of falling inflation and a weaker economy, we expect Treasury yields to trend lower, with the yield on the 10-year Treasury ending the year at a range between 3.25 and 3.5%.
Hi, I'm Elizabeth Henderson. I'm the Director of Corporate Credit. Risk premiums have fallen significantly since last October as the markets now believe the Fed will be successful in orchestrating a soft landing. The corporate market OAS is now inside of its long-term average and around 40 basis points tighter than it was in October. Triple Bs have compressed versus single A's, and we're seeing financials remain wide of industrials as banks continue to issue and REITs and financials continue to have underlying fundamental pressure. From a fundamental perspective, 2022 was more of a return to normal type of year. Companies did improve their credit fundamentals after COVID. So 2022 saw companies using cash to do more normal things like repaying shareholders as well as investing in capital and pursuing M&A. So we did see cash balances decline as well as leverage remaining pretty stable. We expected earnings estimates to fall, which they finally did in the middle part of the year. And that meant that EBITDA margins did contract about 100 basis points. For 2023, earnings, revenue, and capital spending estimates are very nominal, low single-digit type levels, but the market's expecting improvement in EBITDA margins. We believe risks are to the downside for all of those estimates as we continue to see pressure from an economic perspective as well as inflationary pressures, especially in certain sectors, healthcare being one. So that brings me to our outlook. We are in a part of the market where you want to be more disciplined in the way you're investing. Spreads, again, at 120 are at the low end of our projected range. We're expecting a more return to normal type of environment from a volatility perspective, which brings about 20 to 30 basis points of volatility. So our range is for spreads to be in a 120 to 160 area this year. We are advocating sectors that have support fundamentally, either by the nature of their industry that lends itself to more stable cash flows, or some kind of unique driver, aerospace defense being an example of that. Conversely, we're recommending portfolio managers avoid sectors that are more vulnerable to secular or cyclical pressures. Two examples of those are REITs as well as media. When you think about the environment that we've been in with very low interest rates and then high cash and nominal growth rates, that has been very supportive for the marginal company. And that's something that this year we believe will become a problem. So that cleansing, so to speak, of those weaker competitors will be a dynamic that we'll start to see this year. That is what we're expecting will result in more rating downgrades than what we've seen of late, and really means something in terms of how performance is being driven this year and how important security selection will be in 2023.
Hello, I'm Scott Edwards, and I'm the Director of Structured Products here at AAM. I'm responsible for the asset-backed, commercial mortgage-backed, and residential mortgage-backed security holdings in our client portfolios. Today, I want to talk a little bit about our outlook for 2023. It's changed a little bit from prior years. Historically, we've always de-emphasized agency mortgage-backed securities, really and focused more on asset-backed and commercial mortgage-backed securities as an alternative. However, with the Fed no longer pursuing a quantitative easing program, valuations in residential mortgage-backed securities are much more attractive. As you can see from the current graph we have, those valuations, that spread, the yield premium over treasuries has nearly doubled over approximately the last year and a half, going from 70 basis points to now on average about 140. With that, we think that offers a superior return performance advantage going forward relative to these other sectors. Something to consider is also in the commercial mortgage-backed space. We're having some concerns about the performance of office properties that are embedded in many conduit-type securitizations. The performance, mostly due to the increase of working from home, is going to put pressure on valuation specifically related to the amount of space that's currently available in the marketplace. The availability of office space in most major metropolitan areas is up to 20% of the market. We think that's going to put pressure on valuations, and you may see price performance at some of these underlying properties that mimics what we saw with retail and secondary mall properties back 5 to 6 years ago as we shifted to a more of an online performance or online shopping environment. So we're going to, I think, just gives a little more impetus to us to want to de-emphasize the commercial mortgage-backed securities and focus more on residential mortgage-backed securities. Another sector that we like quite a bit is non-agency or non-government guaranteed mortgage-backed securities. Important to the performance of that sector, though, is how does housing hold up? I think we're all familiar with the housing market that spiked in terms of pricing back at the beginning of the pandemic as that demand for housing surged as people sought better places to work from home, but also living in less dense areas. With the increase in mortgage rates, that market has collapsed and sales have plummeted. However, the existing supply continues to be constrained. So we're not seeing a large availability of homes. And in fact, most of the market in existing homes, only 2 or 3 months supply is available. So when you've got a controlled supply such as that, that demand, although lessened, is still leading to firm support for pricing. In fact, if you look on a year-over-year basis, housing is still up 2.3% in pricing across the country. We think that that type of soft landing is going to be created as the fact that housing inventory being tight, pricing will be supported, and we'll have, again, as I said, a soft landing. So we're looking to that as being a real support for the non-agency market, and that sector will continue to be an important part of our asset allocation going forward.
Okay, I'm Greg Bell. I'm the Director of Municipal Bonds here at AAM. I want to talk about the municipal bond sector and the outlook for 2023. Given the volatility last year and interest rates, we had a pretty weak demand profile for the sector. This year, we have a more constructive outlook for supply and demand technicals for 2023. And just starting with supply, we're looking at a modest pickup in supply to about 433 billion overall. Of that amount, 66 billion is going to come in the taxable muni space. That's about a 10% increase over last year, but that's down about 53% from where it was in 2021. The major culprit there is refinancing supply. We're expecting to see a higher interest rate environment this year as last year. So we're going to see a depressed amount of issuance for refinancing activity this year, which made up a major component of taxable supply in the years 2019 through 2021. Going forward and looking at demand, that is expected to moderate from the weakening we saw last year. We saw roughly about 124 billion in outflows out of mutual funds, which was a record. Again, we're expecting to see that number moderate this year. That number is going to be contingent on rates stabilizing. So far, Treasury rates this year have fallen by about 40 basis points. So inflows, those outflows have now turned into inflows for the first 3 weeks of this year to the tune of about 1.6 billion per week. On the legislative front, we're not expected to see much change there with the Republicans taking over the House. With the split mandate there, there's not much of a chance that we're going to see an increase or change in the tax profile. So we're expecting to see high marginal tax rates that currently exist. Will continue to pull in retail investors. For relative valuations, we have more of a mixed view of the market. For tax exempts, we view that sector as being expensive. Roughly right now, the 10-year part of the curve, we're seeing about a 73 basis point give in yield to treasuries for tax exempts. On taxables, we look at that sector as being very attractive. That sector has a yield advantage of about 167 basis points relative to tax exempts on a tax adjusted basis, and roughly 11 basis point pickup versus A-rated industrial corporate bonds. On the credit side, we're seeing stable environment for that sector. We're looking at reserve levels or general fund balances last year hitting a record of 234 billion after very strong revenue growth. This year, we're expected to see that number moderate to about 209 billion. That's still a strong number. We're looking at that number in context to historical levels. That's about 3 times higher than the number going into the financial crisis and 2 times higher than the number going into the pandemic. So we're looking at this sector as being a defensive sector. We're not expecting to see any major credit spread widening going into a potentially recessionary environment.
Hello, I'm Patrick Karwinski, a portfolio manager at AAM, and I will take a few minutes to talk about the high yield and bank loan market. As a quick reminder, these asset classes consist primarily of fixed coupon paying senior secured and unsecured debt, as well as floating secured loans to corporate issuers. Clients can obtain exposure to the asset classes through investments in a fund or by purchasing individual securities via a separately managed account. AAM partners with Municipals & Company, an experienced manager in the space, in delivering this strategy to our clients. The story in high yield followed a similar narrative as we saw in the high grade markets in 2022. Rising rates and widening credit spreads pushed returns to double-digit negative levels for high yield bonds. The Bloomberg US High Yield Index returned negative 11.1% for 2022. Spreads in the sector widened out by approximately 160 basis points, ending the year at 487 basis points. July saw spreads peak at 590. Leveraged loans returns, on the other hand, benefited from their floating coupons adjusting upwards, with the Credit Suisse Leveraged Loan Index returning negative 1.1% for the year. Pricing in the sector has reached attractive levels on an absolute basis, with high yield bonds yielding 8.7% and bank loans yielding 11.9% at year end. Our neutral weight recommendation reflects an economic outlook that will likely be more turbulent for lower rated issuers. Corporate earnings and balance sheets have so far demonstrated resilience. Debt service coverage ratios remain healthy. We do expect some stress to emerge in the sector as consumption softens. However, we are coming off a period of very low default rates and would expect an increase in defaults to approach historical averages. A base case recessionary scenario would likely not see defaults approach bear market levels. Nevertheless, this is an opportunity to focus on higher quality single B and double B rated credits, as well as pivoting towards more defensive sectors. It is a time in the market cycle where individual security selection will play an outsized role. Despite macroeconomic headwinds, this is an appropriate time to maintain an allocation to the high yield sector. Refinancing in the space is not expected to pick up until 2025, and net issuance, which declined in 2022, is expected to continue to underwhelm. Both are positive factors for the sector. Issuance of collateralized loan obligations will also be a technical driver of bank loan demand. Given the level where current yields stand, income is expected to provide positive carry for high yield in 2023. Barclays, for example, is forecasting 2023 total return for high yield for the high yield bond market of 4 to 5%. That estimate factors in an economic scenario where defaults tick up and spreads widen. Despite economic uncertainty and eventual normalization of monetary policy on the horizon, investors in high yield should continue to benefit from meaningful investment income over the coming year.
I'm Tim Seneschal. I'm a senior portfolio manager and here to provide an update on the convertible market. Inflation and interest rates combined to sink equity valuations last year and that made for a tough backdrop for convertible investors, particularly given the growth tilt in the convert market, which was a drag, an additional drag on the market, as underlying equities for convertible investors fell by nearly a third, underperforming the S&P 500, which was down around 18%. We also saw a pretty significant disparity of returns across the convertible market. Those that are closest to their intrinsic bond values were the best performers, as bond floors held in last year. According to Barclays research, those credit rate sensitive securities and those that are balanced in nature realized roughly a quarter and half of underlying equity declines last year, while the equity sensitive segment of the market experienced 83% down capture, having a pretty tough year with underlyings down by around a third. Sector diversification was a pretty big driver last year as well. Tech, media, and consumer discretionary segments are among the largest in the market and were the worst performers, while the energy segment and utility sector were the lone positive performers last year. They tend to be a pretty small part of the market. So managers that index had a tough year, while those that were more diversified fared much better. As we look ahead to 2023, the backdrop for convertibles is mixed. And a lot of that has to do with our outlook for the economy and what that means for financial markets. Given our expectation for a recession, we wouldn't be surprised to see middling or even negative equity market returns, but would note that the market may have already priced some of this in, given the tough equity environment last year, while the economy still hung in more or less. And further, we'd note that there's only been one instance over the last 40 years where stocks have declined more than 10% in 2 consecutive years. So it's not a foregone conclusion that we get another leg lower in equities. On the credit side, our expectation is for wider spreads in both high grade and high yield credit. You've heard that from our corporate team. That may put further downside pressure on valuations, although we note that fundamentals in the convertible market for issuers remain fairly healthy as we enter this environment. One additional note here, and we see it on this slide, is that the size of the busted convert market, those issues that are most bond-like and have lost their equity sensitivity, has grown a lot as equities plummeted in late 21 in this market and through 2022. So the spread and rate duration of that part of the market and as a part of the market as a whole has increased and may make the market a bit more sensitive to those things as we move into this year. On the rate side, that should be a positive catalyst. The balanced part of the market enters the year with current yields that coupon carry that's at least 100 basis points higher than a year ago. So that'll provide a bit of a base level for performance as we enter 2023. And then last but not least, volatility should be a source of positive valuation driver moving ahead this year. We recognize that vol has declined from the elevated levels of the second half of 2022, but we do see volatility hanging in at above trend levels, given the uncertainty in the macroeconomic environment, as well as all of the challenges and the difficult outlook for global macro politics moving ahead. We're keeping a close eye on issuance. That's one fundamental element for buyers of balance paper, and we observe that new issue supply is one source of securities with balanced upside and downside characteristics. New deal flow stalled last year during big chunks of the calendar year during those more turbulent times. And for the full year, the market absorbed only about $28.5 billion in new deal flow. That's a fraction of the new issuance that came in 2020 and 2021. Market conditions have improved a lot since the middle to late part of last year. So With volatility subsiding a bit, equities having rallied, and credit spreads stable and tighter, we have seen deal flow start to pick up, and there is an expectation that the calendar will be much more active this year than last. The dealers, the sell side research firms, are expecting that deal flow will be 2 to 3 times what we saw last year, and that the market has the appetite to absorb that paper, particularly when factoring in the level of redemptions that we'll experience this year from calls and maturities. But ultimately, equity direction will be the primary force driving convertible returns this year, as will curve positioning. We enter the year with portfolios diversified by sector and rebalanced with proper upside potential. So should we see long run equity market gains, we do have portfolios well positioned to capture those gains and generate substantial upside, while acknowledging that a move lower in equities will negatively affect performance in this sector, but managed downside risk and risk control is in place and something that we're watching closely.
2022 seems sure to go down as a landmark year for equity markets. Broadly, US equities were down about 20% for the year, the largest decline since the Great Financial Crisis and the 4th worst year since World War II. The story of the year was really all about inflation and the Fed's efforts to contain it and keep it from spiraling out of control, with an aggressive series of interest rate hikes intended to suppress economic activity and thereby reduce inflation. This was, of course, exacerbated by the conflict in Eastern Europe and the resulting disruption of global trade flows and the impact on energy prices. For most of the year, this was the story. This led to a series of sharp equity declines, though in Q4, we did seem to reach an inflection point. More speculative traders believed that they could start to see the light at the end of the tunnel as inflation began to decline. The pace of the Federal Reserve's interest rate hikes began to slow. This led to a lot of volatility, both up and down, but the beginnings of a more positive trend have started to form since Q4 going into the present day. And this really brings us to our current situation, where we see a pronounced tug of war between multiple factors that will be the defining elements of 2023 in equity markets. Now, AAM was negative on US equities for most of 2022. And while we retain that position today, it's likely we'll soon be shifting to a more neutral or target weight stance as this positive trend builds momentum. However, rather than give a specific outlook for 2023, I just want to give the high level case for a more bullish or bearish outcome, and we'll see how reality ultimately plays out. On the one hand, there is a recession widely expected today, and to some extent that has been priced into markets. The hope is that this will be a relatively short and mild recession, and that it may be accompanied by the Federal Reserve shifting to a more accommodative monetary policy stance to help support markets if inflation appears to be well and truly tamed. If that ultimately materializes, a strong equity rally seems very likely. On the other hand, if inflation should once again rise and once again threaten to spin out of control, requiring further tightening from the Federal Reserve, if the recession should ultimately be deeper and more impactful on earnings and spending and employment than is currently anticipated, and if any expansion of the geopolitical turmoil we've seen in the form of a new war, an expansion of an ongoing war should occur, we could see another sell-off. We could see potentially even more volatility than we did in 2022. So certainly a lot of factors to keep track of here, and we'll be watching closely and continuing to give regular updates throughout the year.
Thank you to those of you who have made it this far. As you can tell, our outlook is cautious. Like the Federal Reserve, we're unsure about the direction of inflation. If it continues to fall while unemployment rises only modestly, then there's a potential for a soft landing. But frankly, we're bond people, and the glass is almost always half empty. And in our base case is that the Fed will over tighten and drive us into a recession. That will push credit spreads wider and raise volatility across these markets. So at this point, we're remaining cautious. But as the Fed continues to tighten here and we get more information about what might happen in the future, our portfolios are poised to take advantage of risk and to the potential for higher yields going forward. Thanks again for joining us.